Ever wondered if private credit is your ticket to steady income? Or is it just a liquidity trap waiting to snare you? Sure, it promises yield, but what's the catch? Tying up your cash for years can feel like a gamble. And don't forget the fine print. Risk hides there. Stick around to discover when this Wild West is worth the ride and when it's best to just walk away.
Shall we move on to private credit?
Yeah. So, Phil, one of the things I really admire about you, besides all the great guests you get on your podcast, is you have made it your mission to help amateur investors and new investors and people who are just befuddled and overwhelmed by the complexity of finance. You've made it your work and your mission to help explain all of these complicated things to people. You have this great podcast, the Stocks and Shares for Beginners podcast. It's on YouTube here. So, we'll put the link in the description. People should go subscribe to that. And I think one area where you're particularly strong is understanding Wall Street jargon and the kinds of things that people who want to sell you financial products will tell you to make you think that something is a good and safe and appropriate investment. And it might be and it might not be, but people have to have the tools and the language to understand it. So one place we're starting to see an increase in attempted sales to retail, to amateur investors, is in private credit. And I know you've got some thoughts on that. What's going on? Why are people trying to sell private credit? Let's start with what is private credit. Let's just explain what that is to start.
Okay. Well, again, I'm not used to being interviewed by like this. I'm just doing some research and finding out. Just to step back just for a moment, I became interested in it because I was reading in the financial press that regulators here in Australia, and I've also found out since that regulators in the United States are concerned about this space for a number of reasons, which we will go into. So I started researching it and seeing what it was all about. And it seems to be, it's something that can be applied to any business, but let's just talk about the real estate, commercial property side of things, which is where private credit plays a big role. Now, in the past, banks in many cases would provide credit to, say, a developer who wanted to put up an office tower. But now there is a market that is at arm's length to the banks that provides funding, say, for an office block. And this was an example recently, and I've used it as an illustration in the written part that comes along with this podcast episode, is that there was an office development here in Australia, in Sydney. Sorry, I'm in Queensland now. I've lived most of my life in Sydney, but now I'm out in the boondocks. You would look at it, knowing Sydney as well as I would say, yes, this would be a fantastic investment. There's a new rail line going in below it. It's right in the heart of the business district. It's going to have gun barrel views straight up gorgeous Sydney Harbour. But then for a whole number of reasons, this company or the development has still not started. I think now nearly 3 years after it was first funded and proposed. And the reasons behind it were things to do with interest rates remaining high, the work from home situation, so that there's not as much demand for office space anymore, and construction costs going up at a great rate as well. So this is now, for me, from what I've seen, is that it's revealing some of the problems with the sector, and especially that of valuation. And how do you actually value something like this? Now, private credit, of course, I'm still trying to work out the interchangeability of terms like private credit, private equity, corporate bonds, but they seem to be just different facets of the same thing, where someone is investing money into a private. That means it's unlisted. You can't work out a value based on a daily basis. Like a private company a publicly listed company would be, you can see what the value of it is moment by moment, whereas it's very opaque in terms of what some of the investments in the private credit space are. I don't know. Am I explaining it well? Just you can sense my nervousness here in trying to explain complex financial instruments. But anyway, sorry, just before you put your oar in here, I'm just trying to say this because I've noticed as well that there are investors who see private credit and they see high returns. They're seeing higher returns than if they put the cash in a term deposit or in the bank or some sort of savings deposit. And again, these are the kind of dangers I'm really trying to point out for people who might be muddling into this area, and some financial advisors saying, oh, you should have your money in private credit. Look at all these things that are going on at the moment. Anyway, over to you, Gary. Have I
All
made
right.
any sense in that in that sort of diatribe?
I think you have, and it's okay to feel befuddled on this. The topic is really confusing. So why don't we actually go through if people want to invest in bonds, and that's really what they're doing. Let's
Because it
talk
is a kind of bond, isn't it, really? It's a corporate
yeah,
bond by another
it's
name.
right. It's a loan. It's a loan.
Yeah.
So let's talk about the kinds of loans that you can make and what kinds of returns you can get, and just help people understand where the risk is, right? So the most basic kind of loan is depositing money in your bank, right? And people say, well, wait, I have a savings account, I have a checking account. I'm not loaning money to the bank. Yes, you are. Yes, you are. You are giving them your money and they're holding it and they pay you a return. They pay you interest. Now, it may be very low, but you're getting that. Now, I don't know what it's like in Australia, but in the United States, we have Federal Deposit Insurance Corporation, FDIC. And what that means
Exactly
theoretically,
the same.
right? Yeah. And I'm going to really lean,
$250,000, I think. Yeah.
yeah, per account. And I'm going to lean really hard on that word theoretically. Theoretically,
Mm-hmm.
you have no risk. Yeah, I know. But if the bank goes under, this insurance will pay. Now, we have not had a situation before where people haven't got that money, but we've had bank failures. You could have a bank failure that is greater than the amount of insurance in there. But, that would be the easiest safe thing to do. So let's go one more step up. You could buy treasury bonds or treasury bills in the United States. Now, is that good? Well, you're going to lose purchasing power slowly, right? So inflation tends to be higher than the rate that you're getting on these bonds. If somebody could say, oh, no, the 10 years at 4%, it's at 5%, inflation's 2.9. You said that earlier in this episode. Yeah, but inflation's not 2.9. And so, over time, you're going to lose purchasing power in this, but you have the advantage of you're going to make nominal returns, just a fancy way of saying that you're going to get more dollars back than you put in. And the government, if they run into trouble, and they do have financial trouble, they'll just print more dollars. So you will get paid, right? The purchasing power of what you get paid with may be low, but you're going to get paid. Okay, now let's go one more step up in risk, and that would be corporate bonds, right? And let's talk about investment grade. You go to like AT&T. Be like, well, AT&T, it's a really good company. It's really safe. They have lots of bonds outstanding. Okay, great. And if you loan AT&T money, you receive a slightly higher return than you would on treasuries. And the reason is there is a possibility that AT&T could go bankrupt. They can't just print more dollars, and you get paid a little bit more. Then above that, there are, junk bonds or high yield bonds where you're loaning money to companies that, you think they're going to pay you back, but it could go either way. And so you get a little bit of a premium for taking the risk that things could go bad. Now, what happens with private credit? The advantage of everything that I've said all along is you can always get something. You can go to the bank and say, give me my money back. You can sell your treasury bond. You can sell your AT&T bonds. You can go sell your high yield bonds. You might take a loss, but you can sell that right now, and go do that. Okay. What happens with private credit is you meet with your financial advisor, and they say, well, Mr. Muscatello, you've done really well. We now see you as a candidate for our private investments, right? Congratulations. We're graduating you. You're moving. Oh boy, I must be important. I have money. I'm talking to a private investment guy. Phil, why do you think you're getting the private investment guy? Is he doing it because he loves you? No, he's getting paid. These guys make a gigantic fees. The fee schedule on these private investments is enormous, right? There's a reason why you're talking to the private investment guy in the special room, and they offer you, your cappuccino instead of just the coffee that's been sitting out for 5 hours. And they make you feel like you're really important and you're doing really well. And maybe you are important, or maybe you are doing well, but you need to understand they're doing this because the fee schedule is different. They make more money off of it. And then they say, well, we've got this deal, and by the way, you're going to get better returns. And you think, oh, good, yeah, this is the thing I heard about. I have more money, so I make more money and I get higher returns. And yes, there is some truth to that, right? And generally, better deals are offered to wealthier people. The poster child for this is Warren Buffett himself. Whenever any company has stress or a problem, they go to Uncle Warren and they say, hey, would you like to invest with us? We're going to give you a huge discount. Right, we're going to make this huge, right? Phil, you and I don't get that opportunity. Uncle Warren gets that opportunity, right? And so you think, okay, great, I'm going to get a better return. Well, here's what you give up. You give up on the fact that you're investing typically in like these individual projects, and it's not like you have a whole company. It's, as you said, you're investing in a building, a real estate deal, which may or may not have the cost structure they tell you, which may or may not start construction on time, which may or may not start construction at all. But the key thing is you're giving up liquidity, right? If you need that cash, you can go sell your AT&T bonds. You can go sell your government bonds. But if you need that cash, you're not going to be able to sell your private credit. And, you could go back to your special banker and say, hey, can you sell this thing? Oh boy, I don't know. I have to look. I have to see if I can find a buyer. And to go find a buyer, I'm going to need a fee for that. And whoever's going to buy it, they're going to want to pay a discount, and we'll let you know in a day or two. Right. And so maybe you get your money, maybe you don't, but you're really locked into these private kinds of things. And so that's why they're offering you a better return. Could it work out? Sure. And private credit isn't necessarily bad. And the person offering you a private credit opportunity isn't necessarily evil. I'm just pointing out, be aware of, because Phil, you love this kind of education stuff, be aware of the terminology they're using. Be aware that the person selling it to you has he is incentivized to sell you that instead of something else. Be aware that these deals do offer a higher return, but they're riskier. And be aware of what it means to invest in something where you're not liquid. And if you have a problem, if there's a leak in your roof and you need money to fix it, right? You go to your private banker and say, hey, I need money right now. Can you get me out of this investment? Well, that may or may not happen. And if it happens, it's going to happen at a discount. So I'm not saying these are bad people. I'm not saying these are bad investments. I'm not saying you can't make a really good return on it. I'm saying understand the risks that you're taking, understand the landscape, understand the person on the other side of the table from you. He's not necessarily your opponent, but he's not your friend either. So just understand all of this and protect yourself. And this is really, really important, right? When these investments are sold, they will imply that if you don't do it, you're missing the opportunity. And there is that FOMO, that fear of missing out. Okay. I really, really want to emphasize this, right? It's don't be taken in by promises of high returns. And remember, it is okay to pass on an investment, even if it makes money later on. And you say, oh, if I don't do this and it makes a lot of money, I'll feel foolish. Okay. So what? Right? It's okay. I pass on plenty of investments that later turned out they would have made a lot of money. They weren't right for me. I didn't think the risk reward was good. Right? Just like it's like going to Vegas, right? You can bet it all on black. Your return profile is negative. You do that enough times, you're going to lose all your money. But hey, the person next to you doubled their net worth. That doesn't mean it's a good idea. It's okay to pass on something, even if it works out later. Don't feel badly about that. Now, if you do, as an investor, if you do think, well, this is something I want to do, but I'm worried, I'm nervous, okay, it's okay to do it. Allocate a small amount of capital, right? Pick funds with good managers.
Always a smaller amount of capital.
Yeah. Don't put your net worth, don't bet your mortgage, your ability to pay your mortgage on something like this. That's all.
Yeah. And it's also to do with the valuations. I mean, that's the other part where the systemic risk can happen. I mean, if you suddenly have a downturn in the economy and all of this private credit is all going into office blocks all over the world and the valuations come down, and that will filter through the system. A lot of these are also, there's a lot of debt involved with them as well. But always remember that you're the last in the credit queue, the creditors queue, the banks. And the banks are involved in this space at an arm's length, aren't they?
Yeah, exactly. Right. Understand you're the exit liquidity, right? That's you're how the banks.
You're the patsy.
Yes. Yeah, right. You're how the banks get out of this. And look, let me give you If you're watching this, let me give you another way to think about this stuff because it
Mm.
can help you. Ask a lot of questions and see if you get answers, right? So one of the things I do at Deep Knowledge Investing is I not only provide transparency to our subscribers into my personal portfolio. Like if you subscribe, you know what I own. I tell you, yeah, I own this much of this much of that. And that's great. So you know, okay, I'm investing in the same way that Gary is. Great. We're invested in the same things. We'll make money or lose money together. There's at least integrity there. But the other thing I do is provide write-ups, constantly explaining in detail why I own these positions. I update people on things. People send me questions. Our subscribers send me questions all the time. They have my personal email. They email me or put a comment on the blog, or, if you go to deepknowledgeinvesting.com, there's an Ask Gary tab. People click on that and ask me questions. And guess what? I give them answers to these things. Or sometimes people ask me really good questions. I'll turn it into a blog post and explain to people. So if somebody says, hey, you should invest in this, it's got a good return. Why? Why are you offering a higher return? Why is this a better return than other things I could be investing in, right? Why are you offering that premium? Is it because you want to help me? See if you get good answers. And if you don't, run away. But if somebody says, hey, that's a good question, let's talk about it, and you get an answer but it's a higher return, right? Which is the finance version of ours go to 11 for the Spinal Tap fans in the crowd. Then that tells you something as well. Is the person who's selling this to you, do they understand it or not? Do they know their stuff? And I think you want to figure that out.
And I think it's also important just being able to have the language that you can ask the appropriate questions as well, and not to be afraid of asking those questions. And again, not to be bedazzled by these financial advisors. Just really think long and hard. And anyway, I think that's a great point to end. What do you think, Gary?
That sounds good. All right. So let's get ourselves wrapped up here. Phil, thank you so much for doing this. So good to have
thank
you.
Thank you for the opportunity, Gary.